Alright, here I'm going to show how to convert collections from the cash sales basis to an accrual sales basis. And what we mean here by a cash basis is where we make a sale and we only record the sales revenue once the cash is paid, and that can be sometimes down the road. Now in the accrual system, we set up here what we call an accounts receivable. So when we make the sale, we would increase or debit our accounts receivable for that amount of the sale, and that's where we actually provided a goods or service, and then we would credit or increase our sales revenue for the amount of that sale. And then once the customer pays for the sale, pays payments, or we receive receipts on that sale, we'd reduce our accounts receivable or credit it, and then we'd debit or increase our cash account. But for this calculation here, for calculating from the cash to the accrual basis, I'm going to take any of the changes here in our accounts receivable, be it a debit or credit, and the balancing entry would go to our sales revenue. So for example here, if we had a debit amount here in our accounts receivable, I would credit our sales revenue, and if we had a credit here in our accounts receivable, I'd be debiting our sales revenue. And that's simply for making this calculation here for our accrual basis. Okay, let's set up here our accounts receivable for the accrual sales. Now remember, this accounts receivable here should be reduced by any of the accounts receivable written off as uncollectible. So let's look at our first case here where we had an increase in our accounts receivable of $50,000. So our beginning of the year balance was $100,000. The end of the year balance was $150,000. So what we would do is we debit or increase our accounts receivable by that increase for the year here of $50,000. Now looking at the case here where we had a reduction of $10,000 in our accounts receivable, beginning balance was $100,000 and the ending balance for the year was $90,000. So we had a reduction here of $10,000. So we'd reduce our accounts receivable by that amount or credit it for that amount. Now looking at the first case here where we actually had an increase in our accounts receivable, we would debit that for that $50,000, and then we'd have the balancing entry go here to our sales revenue, or credit or increase our sales revenue by that $50,000. So to determine our accrual basis, we'll take the $100,000 cash basis, or the cash that was received for the year, and add this $50,000 increase here in accounts receivable, and our accrual basis would be $150,000. Alright, let's look at the case here where we had a $10,000 reduction in our accounts receivable for the year. So we'd credit or reduce our accounts receivable by $10,000. And in that case, we would have normally debited our cash for the $10,000. That's the amount that we would have received. But for our calculation purposes here, this credit to accounts receivable of $10,000 or reduction, we would take the balancing amount or debit our sales revenue for $10,000, or that would be a decrease here in our sales revenue, because that for our accrual basis we would not have recognized that as sales revenue at that time. So we reduce it here by $10,000. Now if we compare it to the cash basis here, a credit amount of $100,000 for the year less this debit here of $10,000, our balancing entry here would be $90,000, and that would be our accrual basis. So what we've done here is we've reduced our accounts receivable, and we also reduced our sales revenue by that same amount here for calculating our accrual basis. Okay, let's look at the case here where we had a reduction of $10,000 in our accounts receivable for the year. So we'd go in here and we'd credit our accounts receivable or reduce it for $10,000, and then normally our balancing entry here would be to debit cash or to increase cash for the $10,000 that we received. But for our calculation purposes here, I'm going to take this credit amount here of $10,000 in our accounts receivable, and I'm going to balance it here with a sales debit amount to our sales revenue for $10,000. So our reduction here in accounts receivable of $10,000 will reduce our sales revenue by $10,000. So to calculate our balance here at our accrual basis here, we would take our cash basis, the credit amount here of $100,000 less the debit amount here of $10,000, and the net amount here would be a credit of $90,000, and that would be our accrual basis. Okay, when we converted our cash sales basis here to an accrual sales basis, we've used this accounts receivable account on the balance sheet. And any changes in our accounts receivable here were balanced with our sales revenue on the income statement. So if we had an increase here in our accounts receivable, we'd increase our sales revenue. And a decrease here in accounts receivable would decrease our sales revenue. And then to determine our accrual basis, all we did is we took our cash basis for the sales revenue for the year and added back any increases in our accounts receivable, or we subtracted any decreases in our accounts receivable, and that net amount here would be our accrual basis for the sales.